Hey, I'm Gene Goldman. Here's a look at the week ahead for the week of August 21st. The mood on the stock market has clearly changed. Sentiment has turned a bit negative, and the path of least resistance for stocks seems to be lower. The jump in bond yields has really hurt stocks. As you see here, for example, the 10-year U.S. Treasury yield has jumped, and now it's at 4.25%. So let's discuss why bond yields are rising, why it matters to stock investors, and what we're watching this week in terms of direction for bond yields. So bond yields are rising for a few reasons. First of all, the economy has proven resilient. We saw July retail sales come in stronger than expected. Second quarter GDP also came in better than expected. And if you look at third quarter GDP estimates, looks pretty strong. You see here, for example, the Atlanta Fed GDP now, which provides a fairly real-time view of GDP, is moving higher. So if the economy is stronger than expected, this creates possible inflation pressures and therefore potentially higher bond yields. Another reason yields are rising is just classic supply and demand. More supply of treasuries, but less demand. Supply of treasuries is rising because the Treasury Department is issuing more treasuries for funding needs. Also, budget deficits are rising on slower tax receipts. And the Fed continues its quantitative tightening program, where they're basically selling treasuries each month. On the demand side, the Fed meeting minutes last week basically said the Fed is not in a hurry to cut interest rates. Investors viewed this perspective as there's no need to rush in to buy treasuries to lock in yields because yields are poised to stay higher for longer. If yields were likely to fall, in theory, investors would jump in to buy and lock in those higher yields. So why do higher yields worry equity investors? Well, most importantly, higher yields leads to higher borrowing costs for companies. It hurts profit margins, it increases costs for projects and expansion. Also, higher borrowing costs hurts us as consumers. For example, mortgage rates move higher, auto loan rates also rise. And in theory, all this together slows economic growth. Another reason higher yields worry stock investors has to do with how investors value companies. So when an investor values a company, in general, they simply look at future cash flows and earnings. They try to figure out what all of this is worth today. The higher the rates, the longer the present value of the company. So for example, tech stocks usually struggle in the most in this type of environment because there's lots of rapid growth assumptions built into them. If rates rise, it eats faster into the present value of tech companies. And no surprise, the S&P 500 tech sector is the worst performing sector in the S&P 500 this month. So what are we watching for this week? There's not too much in terms of economic data. Instead, we're going to focus on the Fed's annual Jackson Hole Symposium, highlighted by Chairman Powell's economic speech. Though he will likely stress that the Fed is continuing its fight against inflation, if he suggests more rate hikes are likely, markets are likely going to further struggle on concerns that yields will move even higher. So the key takeaway this week, markets are nervous about higher rates, and rightfully so. Rising bond yields are pressuring stocks. The market is grappling with more supply of treasuries and overall economic reacceleration. Rising bond yields are not usually a good thing for stocks. Thank you for listening. For more information, please follow us on Twitter at CeteraIM, and see you next week. And thank you.